Welcome to the Live Squawk podcast, where professional traders, investors and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Before we dive in, if you want the news that moves markets delivered in real time, 24 hours a day, check out Live Squawk. It's our audio squawk service trusted by serious traders worldwide. Start your free trial today at livesquawk.com. No credit card required. Hello and welcome to the Live Squawk Week in Focus on Monday, the 13th of July, 2026. This is our weekly briefing, which aims to break down the key stories from the past week and explore the subsequent implications for the markets. We'll also look ahead at what's coming, giving you a heads up on the events and data points to watch out for. Before we get into it, a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. I'm joined today by Sam Cutler of 333 Capital. Sam's been on a number of times and is always well received by our listeners. So hello and welcome, Sam.
Hey, Harry. Thanks for having me back on, bud.
Always a pleasure. Just a quick recap then, if we go over what the week that was, because I don't think last week was particularly interesting, but there were some points that we'll get through. It was relatively quiet in terms of major data points, but renewed attacks between US and Iran forces in the Gulf has led to higher oil prices and fears that inflationary pressures remain the overriding issue. US President Donald Trump, back end of last week, clearly frustrated by the renewed hostilities, said the ceasefire and memorandum of understanding were effectively over. However, he did leave the door open to further diplomatic talks between the two sides. Barclays said that geopolitical developments and domestic politics continue to drive volatility across energy and sovereign bond markets. The resulting uncertainty over inflation, alongside growing fiscal risks, is complicating central bank decisions. If we could take a quick look at the week ahead, again, US inflation will be the week's main event, with June CPI likely to shape expectation of the Fed Reserve's next move. Lower fuel prices should reverse much of the May energy-driven increase, although underlying inflation is expected to remain firmer. One of the other things we'll talk about today is Fed Chair Kevin Warsh semi-annual testimony to Congress this week will be closely watched. It's his first appearance as Fed Chair for his assessment on the inflation outlook and the possibility for further rate moves. It says further tightening, but I mean, I don't think that would please the president himself. But initially, we'll start at the week just gone. FOMC minutes were last Wednesday. The minutes from the June meeting struck a hawkish tone, generally, showing a growing concern that inflation pressures had broadened beyond energy into areas such as transportation, airfares, and services, while policymakers unanimously kept rates unchanged at 3.5% to 3.75% range. However, several participants argue that the case for an immediate hike, with most indication that they would support tighter policy if inflation remained persistent. Obviously, the meeting was before we saw the resumption of the attacks between the US and Iran, and which has obviously then seen higher oil prices at least, and potentially could seep through into the US economy. Sam, we'll start with the minutes. And anything from the minutes that stood out for you?
Not really in the minutes, no. I tend to view the minutes as fairly stale data, and you can usually see that by very limited market reaction to anything that come about. I think it was pretty much what you would expect. Tilted definitely to the hawkish side. A bunch of members had penciled in the possibility of rate hikes. And we had talked about this briefly before we started recording too. I think, a lot of these central banks right now have to kind of hold that hawkish edge just to not loosen, financial conditions, because everyone right now is essentially responding to spot crude prices, right? Like the rise in inflation that we've seen has been primarily driven by energy prices, right? That's going to reverse this month, but now this kind of ceasefire takeoff has reignited some oil. Although, I mean, look, $75 a barrel on WTI, or like 79 on Brent, a little higher.
It's not
I
crazy.
think we're going. Yeah, I don't think that central bankers are going to continue to. You're not going to react mechanically to what the spot crude price is doing. You need to see those transmission channels from higher inflation seeping into other aspects of the economy. And like we spoke about too before, I think the wages are going to play a huge factor in that. If we're not seeing accelerating wage growth, I have a very difficult time seeing the transmission channel from higher crude, higher oil prices carry over. So I think, central banks have to sound hawkish. They want to sound hawkish, but I think the speed at which markets are pricing these, especially in the US, needs to be taken with a little bit of caution. And I think, again, minutes to me are usually stale. You pretty much know what's in them. I think more now that Warsh has ditched forward guidance, I think the data prints are going to be a lot more reactionary. And I think that's a very different environment than a lot of people have been used to in the past regime, where everyone pretty much knew exactly what the Fed was going to do at any given time. So I think that's going to induce a bit more volatility, and we're going to see a lot. I don't want to say a lot more volatility, but I think we're going to see the ranges expand, and we're going to see more movements on these, data releases as they come out. So,
well, as a previous trader and a long time ago now, before I started this business. What I can say is, for those intraday guys that still trade, there'll be music to their ears. Less forward guidance, more dependence on the data points as they come out, and forming an opinion of what the Fed might do based on that gives them far more opportunity. So I think that for some, this will be cheered and will be welcomed in terms of the forward guidance. And also, again, back to the minutes, we did hear from the likes of Waller, Michelle Bowman spoken in recent days. Waller, back on the 7th of July, stressed that monetary policy must remain focused on returning inflation to target, arguing that policymakers should respond to incoming data rather than the assumption about future disinflation. He also suggested that the current stance is appropriately restrictive, but did not rule out an additional tightening. Michelle Bowman spoke on the 7th, as she spoke today. Actually, she didn't really say update much from today's speech, but said they centered more on the banking supervision, AI, and financial regulation, which is her kind of remit more than anything else. Right, so that's last week's again minutes out the way, which again goes back even further as we've noted. I want to turn to Canada now, north of the border. We saw labour market data held broadly steady. And we've got a BOC meeting this week, so timely in that respect. What did you make of the Canadian labour data?
Yeah, I mean, you look again. You just look at the broad headline numbers. It looks fine, but it's not. To me, the Canadian labor market isn't fantastic. Like, if you look at the last report, yes, it was better, but I mean, the primary driver of that report was all in part-time jobs. I think full-time jobs printed like 600. So I think, the full-time employment metric is weak. Obviously we have some summer months here in Canada. You could possibly also see, some of that World Cup. I believe we spoke about this last time. You could see brief little jumps in that in part-time employment. We didn't so much get that in the US on the last labor print, but we might have seen a little bit of that there in Canada. But I mean, wages and core are pretty much contained here in Canada. They don't seem to be running outrageous. Headline is somewhat elevated, but a lot of that is energy costs.
Well, again, when you talk about wage growth, again, it was firm, and some say it reinforced the Bank of Canada's view that labour market conditions have eased only gradually and leaving policymakers cautious about signalling any near-term policy easing. And we'll find out tomorrow, as I said, from the BOC, where they say we are expecting rates to remain unchanged. Oh, sorry, is it tomorrow or Wednesday? Well, I think it's Wednesday.
It's on the 15th, yeah.
Yeah, so Wednesday.
Yeah. I mean, I expect them to. Yeah, I expect them to stay on hold for the rest of the year.
Yeah, which I think is the consensus.
Yeah, I don't see them making any moves.
Okay, just quickly moving on then. Mainland China inflation data, we saw modest price pressures there, but there's an issue with domestic demand and whether there's enough of that domestic demand really to lift inflationary pressures over there. One to watch, obviously, the energy sector and the pipeline inflation, and where it gets its oil from will matter to the Chinese economy. And just quickly moving on, RBNZ official cash rate for July, hawkish hold, acknowledging inflation risks. And it said that policymakers acknowledge persistent inflation risks, but judge that current policy remains sufficiently restrictive. It was 50-50. I mean, it erred on the side of unchanged, but I know the consensus was only just for unchanged. A lot of people were looking for maybe a move from the central bank. And I think, again, people remain defensive on that one. Current policy remains sufficiently restrictive, said policymakers, signalling that future decisions will depend on incoming inflation and labour market data, as you maybe would expect. Right, let's move on to the weekend, because I think it's far more interesting what we have coming up than what we've seen, really. And the headline for this week will be CPI report, which comes tomorrow. Will we see a reemergence of heightened inflationary expectations? What's your view on tomorrow's CPI?
Yeah, so I mean, look, I think the consensus, everyone has it more or less printing negative, right? Sure, you can come and say, okay, it's going to be the first negative print since I think like 2020. So, headlines can be a little misleading on a lot of these fronts, because I mean, look, this is definitely going to be driven by pretty much just a drop in energy prices, right? I think if you look at AAA data, like the daily AAA data, it shows that average gasoline prices, I think in June, are running like 10% below May levels. So if they're running 10% below May levels, you do a little bit of math on that, I think that's going to be around like 0.4 to maybe 0.5 percentage points off the headline CPI number from that. So I think it is very feasible that we do get a negative month over month print. You're going to see the annual rate drop back down into the 3s too from the 4s, but I think there's a couple little sketchy areas in the core area that are going to remain sticky and maybe do flag some upside risk to the year over year number, right? And one of those is in used cars, right? I think everyone on this print, take a quick look at the used cars numbers, because we have a gap that I think is going to need to be closed. And I think that will add pressure onto the core. If you look at the Manheim index, right, and that typically has a lead time on the CPI used car component by like 1 or 2 months, right? That index rose 0.1% in June, and it's up 2.1% year over year, right? So if you compare that to the CPI, May shows a 1.5% decline. So I think there's a little catch up here that needs to be done. So I think there's a possibility we see, used cars prices to continue to improve a little bit, and that could add some pressure on that core number, which kind of leads me to potentially saying it could be stickier, or we have, the risk to print higher. I think everyone's expecting it like right at 2.9. I think there's some risks. You get a 3 handle in front of that. And I think that also has, you can spill this over into rents, right? I think rents are also a really key component here. A lot of people have talked about, the disinflationary trend that we've seen. And I think, it's so hard to come to a definite conclusion on this, but it kind of looks like the disinflationary trends might be coming to an end, right? If you look at some of these, I guess we'll call it, the higher frequency data metrics, right? Like Zillow. Zillow has a rental inflation metric that tracks newly listed properties, and it's a lot more reactive than the CPI shelter measure, right? So CPI captures pretty much like tenants and new signings, and the Zillow measure is pretty much rental inflation on newly listed properties. And if you look at that metric, it's been trending higher than expected, since pretty much this spring. So I think that's something to keep an eye on too. And then if you want to jump into a little bit more on the technicalities here, which is one thing Warsh or the Fed could have going for them, is that in September, the BEA is changing up some calculations on the PCE deflators for portfolio management fees, legal services, and I believe softwares in there too. So traditionally, like the PM and investment advice fees, they pretty much just simply track like asset prices, right? You get a surge in the S&P that's mechanically, lifting implied fees, and that feeds through into, a higher PCE inflation metric, right? So they're going to incorporate some changes in there. I don't know exactly tit for tat what exactly those changes are going to be, but there's estimates that it's going to reduce core PCE by roughly 20 bips for the year.
Exactly what I was going to say, yeah.
Yeah,
You cool it a little bit.
Exactly, yeah, but it's also going to lift some in the prior years. So that could be a little convenient, for Warsh and the Fed, despite what's going on. It's just kind of maybe a tick in the pros box there. But, I think like we spoke about before, the market's point, we're basically at a spot, where whatever you want to call it, traders, investors, that everyone's kind of seeing now that this Middle East conflict is probably going to persist long enough, and it could alter, U.S. monetary policy. And like we said before, I think the speed needs to be watched, because I really don't think it's going to happen as quick as markets are pricing. Like if you look here, like even the 8 bips of hikes priced for July. Now, obviously, there's like some funding stuff going on behind that as well. But I mean, 8 bips priced for July. I mean, the materialistic of anything like that happening seems pretty low to me. And I even think the chances of the September hike are quite low. Right. But like we spoke about before, it's tricky. You pretty much have to watch whether, the recent increase in, energy inflation is going to become broad enough, persistent enough, and, visible enough.
They will be looking for this to be entrenched. And like you said, and like we've discussed before, again, the way you need to see it through the wages more so than you would do in the volatile energy and food sector for the monetary policymakers rather to be that concerned to want to act sooner rather than later, and that's not there yet. If indeed it comes at all, and we've seen wages actually, like you said as well, it's not reflecting that in any way, shape, or form. We'll have PPI a day later as well, which obviously inform us on the core PCE reading. But we are looking for another decline in factory gate prices as well, which would take the annual rate to around about 6.2 from 6.5% for PPI final demand on an annual basis. I think we're looking for a decline of 0.1% on the month as well after May's sharp rise. So a big fallback there as well. So yeah, I think you're absolutely right. But I think the bets will start to grow on September and what we're likely to see then. We touched on. We'll look at the Fed next, because what we will have, and we'll get a better insight, hopefully, if politicians don't grandstand and just make it all about them. We will get some insight from Fed Chair Warsh. This will be his first semi-annual testimony, what we used to call the Humphrey Hawkins testimony, to both the Senate and House committees, banking committees, and it's Tuesday and Wednesday. And it's always been quite insightful if you can be bothered to sit through the 3.5, 4 hours of the testimony itself on each day, and the pomposity of the politicians that have to ask these big grandiose questions. But nonetheless, you'll get the Fed chair speaking. What will you, it's a broad question, what will you want to hear from him? Or based on what he said before, are we not likely to get anything particularly new out? And it's more about mechanics of, as you said, what we're likely to see come this end of year review of the Fed.
Yeah, I mean, I don't think we're going to get too much new from him. And I think this is one thing I like about Warsh. He's pretty good at communicating through these, as we've kind of seen in some past stuff. I like Warsh. I think his communication is good. I think the way he speaks is good. I think it's a little bit timely that we're going to get him speaking right after the inflation figures come out. So I think, I mean, I would assume there may be some questions about, the June inflation figures and if that's going to impact the likelihood of hiking rates, later this month, 2 months from now, or, anything to that extent. I do think, the fact that he's made efforts to reduce forward guidance might slightly come under pressure as they kind of just want to, I guess, get some clarity from him. But I think he's going to do a good job at, not leaning into too much forward guidance and just kind of talking his way around like we did, and reiterating the fact that they've formed these, I'll call them what they call them, task forces, right? To get a better read on some of these metrics, and they want to get a look at some of this data and see all that stuff before, making any acts. So I think it's going to be a lot of similarities to what we've heard from him prior.
I don't think there's going to be too much being made of Warsh's testimony. I've got TDF Securities here. They say Warsh testimony unlikely to have a forward guidance, but could have more details on task forces, as we've mentioned here. But everyone's saying it's quite sanguine about what we're likely to hear from him because of his own commitment to less forward guidance. And again, it makes it harder for people like us to sort of create a narrative. But then it broadens that scope and potential for market movement, really, as we've also discussed. So interesting from that perspective. See how he fares against the Democrats at his first hearing, whether they'll give him a good time, whether Warren will just attack him out the gates, which is always quite fun to watch how she has a go at people. So yeah, from that an entertainment point of view, there may be some interesting bits from it, but in terms of informative narrative, I don't think we'll get much there anyway. Looking then at what we have, we got Bank of Canada obviously tomorrow. Bank of Canada, we aren't expecting them to change to keep rates on hold for now, but they have had this, I don't know if it's a dichotomy, but you look at the domestic versus the international picture for them, and domestically, it's hard to argue really that they should be looking anywhere near hikes at the moment from what I've read. And really, it's also, from the other side, really not the easiest proposition for cutting at this moment because of what we're seeing externally. What are your views on Canada, but the Bank of Canada rate decision specifically?
Yeah, I mean, like I said, pretty much exactly what you said. I see them on hold. The inflation picture here I'll call it a little brighter than on the other sides. I mean, inflation, like we said, it's somewhat elevated, but overall, it's pretty contained, and we don't have those stronger wage pressures here that could drive it. I mean, I'm here in Canada. I'm in Quebec, and you're looking around here, you're not seeing the economy performing exceptionally well, right? You look at the housing market here, you're seeing, just driving around the neighborhood, you're seeing for sale signs up a lot more. You're seeing those for sale signs stay there a lot longer than you used to in the past. You speak to friends, you're not hearing about a lot of people switching jobs or looking for new opportunities, right? Everyone's pretty contained with doing what they're doing. Food prices here have been continuing to climb. It's elevated, but that's kind of like everywhere. And I don't think that's going to be a major driver to really change anything here. Our employment is messier. I mean, even though we did get the unemployment rate down, I mean, like we spoke about before, a lot of those gains have been in the part-time jobs things. You're not seeing full-time employment really accelerate. There's still, trade talks with the US that the BOC continues to mention that could be, a negative effect on growth here. So I think they're in a standstill. They're in a standstill with no need to do anything. I don't think there's an urgency to really do anything as well. And I mean, if you look at markets too, you kind of see that in the behavior of Canadian rates, right? Like if you look, just take the stirs, put them in a bucket together, right? Like the UK obviously has the much highest beta of them all, but if you look at Canada, they're moving in such smaller increments than anything else. I think the market kind of agrees with it, that we're not going to see any risk in Canada, right? I still think the market's leaning a little more on the hawkish side. Last time I looked, I think there's still like 20 bips of hikes priced into the year end, but I think that's more kind of just your tail risk again on the energy front, and I just have a very hard time seeing any of that come to fruition this year.
Yeah, you're not alone. You got National Bank financial caution the central bank against rushing to tighten. Canadian employment increased by 18,200 after May's 88,000 gain. And we mentioned unemployment declined to 6.5%. However, it said most of the June's increase came from the part-time, as you mentioned there as well. The bit that was interesting to me was NBF predicted the labour market remains in a slight excess supply, while composition adjusted wage pressures are contained. And it's uncertainty around Canada's future access to the US market is also making businesses more cautious about hiring and investment. So as you rightly said, and so they agree with you, it's really about status quo at the moment, and ultimately, for the time being, it's going to be reflected in the markets. I haven't put it down here, but we've got UK GDP also due up this week on Thursday. Just a note here from the banks: the economy is expected to grow by 0.1% after contracting by the same amount in April, although this risks remain tilted to the downside. Stronger manufacturing surveys and rebounding retail sales provided some support, but services and construction indicators remained weak as higher energy costs and interest rates squeezed demand. I know you look at this from the outside and you have a passing interest. I'm probably underselling it, more than a passing interest in maybe UK markets and assets. From an investment perspective, and and you're in the business of that, do you leave it alone right now? Is the UK not something that interests you at the moment?
I'm still dabbling in the UK store market.
Okay.
Yeah, I mean, especially after these recent moves. I mean, you just look at the moves in here today too, especially if you go out to December next year. We're pricing in almost 2 hikes out until the end of December 27. And I can't say like the data coming out I necessarily have a specific view on, but I lean to continue to expect weakness, right? We've seen mixed labor market weakness. We're seeing slowing wage growth. Inflation printed much lower last time, but I believe it's going to turn higher this month. I've read a lot of reports on, excuse my pronunciation, that, what is it, the OFGEM, the price cap rise?
OFGEM.
OFGEM, yeah.
Although OFGEM is only one F. OFGEM, but it's OFGEM, yeah.
So, the likelihood that that's going to lift some, household utility bills, right? I think it still puts the Bank of England in a tough spot, right? You have decent political risk right now, which is definitely going to continue to add pressure to the gilts market. I think you have the bank that needs to kind of give the impression that they're not going soft on inflation, even though the economy is just in no position to absorb tighter policy.
You said it's soft. The UK economy has bumped along at the bottom for a while now, and we've had the last 2 years, for example, we've had a good start to the year, elevated economic activity, and then it's tapered, and it's been the same way the last 2 years. It seems to be heading that way this time around. That we will get a small effect from the World Cup in terms of activity and maybe retail sales starting to pick up in the near term. But ultimately, unless we get, and who knows, we got a new prime minister coming in, it would seem, in Andy Burnham, you'd hope he'd want to try and inject some growth into the economy. But I think the market would find that hard to see at this point without seeing some higher taxes, and that is not really the sort of thing that initially brings growth. So you'd want to see some growth initiatives from him, and we'll wait and see. Really, the jury's out on that. Just to round things off, then, we've got US retail sales. We're talking about retail sales. The US consumer has been the most resilient of the most resilient. Everything that's gone on this year, everything you seem to throw at the US consumer, US household, they seem to bat away and still go out there and buy, still go out there and consume. I've got a note here that says that Amazon Prime Day and World Cup related purchases should retain some firmness out there. Control group is expected to rise. Another resilient underlying reading would suggest household demand is holding up despite elevated borrowing costs and continued uncertainty over inflation. It's as you were, really. Maybe slightly slower pace for retail sales, but again, there's nothing in that picture, I would say that's a particularly alarming. Do you agree?
No, I think nothing at all. I think you drove it fine. I mean, the drop in gasoline prices, it's going to cause those gas station receipts to fall. So that's going to weigh on the headline number. You look at some of this alternative stuff like Redbook, right? Like you said, like the weekly same store sales there continue to rise. There might be some seasonal noise right around the July 4th holiday, but I think the trend here pretty much suggests that control group sales, which is essentially the best measure of core goods spending, is going to post another healthy gain and stay on trend. It looks reasonably well.
Fantastic. And on that bright note, we're at the end of our time now, nearly bang on our 30 minutes. So Sam, listen, thank you very much for your input today, and again, it's valued as always.
Yeah, thank you, Harry. Always a pleasure chatting.
Awesome. I hope you'll be cheering on England in the World Cup semi-finals.
Yeah,
because we're still in it. Well, we're still in it. We're still hanging on in there for the time being, anyway, at least. And if that does come off, then I expect GDP for June and July to be a lot better than it's likely to be for May. But in any case, thank you very much for your salient words and points of view. So thank you.
Always a pleasure.
I'd like to thank everyone else for listening today, and you can pick this up on our social media platforms or on the podcast platform of your choice that you listen to. Go back and listen to this from the start, and it'll be posted everywhere for you, and reference it during the week. And you can also go to livesquawk.com and pick up any of the reports and notes that we've mentioned on the show today. But thank you, everyone. Thank you to Sam, and we'll see you again soon. LiveSquawk keeps serious market participants ahead of the news around the clock. Start your free trial at livesquawk.com. Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.